So this is a very interesting topic, near and dear to my heart. As a first-time fund manager, it has been educational and humbling experience, but one that is definitely part of the entrepreneurial journey. So I think I've already introduced myself. So let me just start by turning to Bryan, and then if you could go left to right with quick introductions. One request as we're doing introductions is to also, for the LPs in particular, would love to sort of share a comment or two about first-time fund managers and the way LPs look for things. And I think for the fund managers, would love for you guys to comment about the one thing you wish you knew when you were starting your journey as a first-time fund.
I'm with Liberty Global. We are, today I think I'm wearing an LP hat, but we're actually primarily a placement agent, focused on emerging markets, private equity and venture capital. Founded in 2002, we're headquartered in Boston, with a team in Amsterdam, California, and I cover Asia for the team out of Jakarta, Indonesia. We have been in India, working with Indian funds since about 2005. Our LP networks are primarily strongest in North America and Western Europe, covering everything from foundations, endowments, insurance, pension funds, fund of funds, family offices, sovereign wealth funds. Currently, we work with 3 to 4 fund managers per year globally. 3/4 of them are usually past relationships that we've worked on previously. We love first-time funds. Currently, we have 4 funds that we're working on. All of them are actually past relationships that we've raised capital for previously. But all, when we first started working with them, were first-time fund managers. Now they are all raising their 2nd to their 4th vintage funds. So that's a little bit about us. One thing that we'd love to see when a first-time fund manager comes to us is that they've done their homework, that they know what interests us, and particularly for LPs that they talk to, that they understand what the LP is looking for. And if they haven't, then they should start their meeting by asking the LP about it. And then they can talk about how their story fits the strengths of that LP and really will resonate with them. I see so many GPs that go out and say the same exact thing to everybody, and that really doesn't work. But then on the flip side as well, there are many fund managers that will say anything to anyone in order to get their first fund raised, and that really doesn't work. LPs see through that. So
we are a relatively unique animal in terms of first-time funds, because we are a first-time fund, but also we have been in venture capital for the last decade. So we are a spin-out fund, as they call it. My partners and I used to work at a fund called Helion prior to this. One thing I wish I knew when we started fundraising was really how different fundraising for a fund is compared to fundraising for a startup. In a startup, you need to convince one guy to fund you. When you're raising for a fund, you need to convince multiple people all at the same time. So that presents coordination problems that I wish I had known about a year ago.
Hi, my name is Narayan Shroff, and I represent Barclays Wealth and Investment Management in India. So we've been around for now 9 years in the country, and even before that, my role, pretty much over the last couple of decades has been around looking for managers and looking for the right managers for our clients. So it's more of a fiduciary role, not directly taking the exposure, but for our clients, for sure. And in terms of the first-time fund managers, definitely in a country like India, we do feel there is a big space for that. We don't have a long vintage in the country to, in any case, boast about too many follow-on funds. So you have to rely on first-time managers. What we look for is, what managers would themselves look for in case of startups, or when they are looking for, let's say, investing into mid-cap, small-cap companies, is that how are they differentiated, from anything that we can anyways access in either listed space or in the unlisted space, if you were looking at, the follow-on larger fund, houses who are also, by the way, when it comes to the country, willing to go down in terms of the size to tap into those opportunities. So I think the basic question, and it starts and stops at that as to how you differentiate it, what is the niche that we are trying to look for? What is given for first-time managers, mostly, and I would say 99% of cases, is that they don't come with very large teams, very large infrastructure, large sponsors to be able to back it. But they do come with a lot of passion, a lot of focus, and a depth of hands-on experience, like Ritesh said, spin out. So they have a lot of experience in managing hands-on those portfolio companies. So those are the things that we look for, but it comes at a cost because it is a marriage when we are looking at blind pool money. It is a long-term marriage that our clients are getting in, and we're very, very cautious in selecting the appropriate fund for our clients.
My name is Heramb Hajarnavis. I'm with Sealink Capital Partners. We are an investment firm that focuses on the mid-sized Indian opportunity. We're a spin-off from KKR. My colleague Karthik and I were at KKR for about a 4-year period before we started Sealink, prior to which I was at Goldman, so about a decade-long experience investing in India in the private equity space. We found a big opportunity in the mid-market for various reasons that we can talk about, but that's what we're really focused on. In terms of one key takeaway from the initial experiences of trying to raise a first fund, I would say is the need to be a salesperson. I think as an investor, you do end up wearing a lot of hats as you're working with your companies, whether that's finance, strategy, HR, what have you. But I think when you're raising a fund, you're in a sales mode. It feels like all the time, and especially first-time fund, even to get your first employee on board, you need to convince them of your vision, your dream, and why it all makes sense for them to leave the lucrative careers that they've been pursuing to come join you. And so that's been a big learning and I would say a good learning as well as we move forward.
My name is Abhishek Sharman, and I run a consumer and services early growth stage focused fund called Carpedium Capital. We raised our first fund last year in September. We manage about $30 million in a blind pool and about another $10 million in co-investments. And my biggest learning was that when we talk about fundraising, everybody knows that fundraising is a challenge, it's going to be difficult. But the biggest issue that I found actually was the fact that the regulations and the other issues related to fundraising, most of the time, the anomaly that I draw is that you need to have buckets of various sizes to try and get the water which is coming out of various taps. And most of the time, and in many occasions, actually being able to have the right bucket at the right time is a big challenge. So we raised a small pool of capital, but we learned a lot about blue sky guidelines, about who you can solicit, who you can't solicit, the back end, what it takes to empanel an investor, check the box, and so on and so forth. So actually, I think that the issues associated with creating the right structures for fundraising is often not given its due importance and due description, because that actually, to my mind, is probably one of the most difficult parts of a fundraising process.
Hi everyone, I'm Amit Dabas from HQ Capital. HQ Capital is a global investment management firm, and we manage $11 billion in assets. We invest into private equity funds globally as well as in Asia. So we invest directly at an LP. We also purchase secondary LP stakes in private equity funds. We make co-investments alongside the funds we are invested in, and we also make direct secondary investments. So the one thing I would like to say to first-time fund managers is that we have a lot of respect for you. So, it's a really tough job, as Ritesh mentioned. You have to convince 20 different people to come into your fund. And frankly, we need first-time fund managers in the industry. Without first-time fund managers, the industry will stagnate. We need fresh blood. So I think it's a tough decision. It's a tough decision that you have made, and we respect you for that.
Great. Well, thanks. That's a great round of introductions. So maybe Amit, just sticking with you. Obviously, HQ looks at fund managers globally. How would you sort of assess first-time fund managers coming out of India? Is it exactly the sort of same screen and parameters that you would use? Are there any sort of customizations or tailoring that you would do as you sort of evaluate them? And maybe I'd love Bryan to comment on that as well, given your global experience.
I think the private equity industry in India had evolved. I think if we were looking at private equity fund managers 5 to 10 years back, most of them had like no track record to speak of. And it was more like, hey, I'm a smart guy, trust me, give me the money, I'll make good investment for you. While the first-time fund managers that we are looking at today, they have normally worked within private equity industry for a decade or so. They have a track record of making investments and hopefully a good track record of exiting some investments as well. So I think the industry had evolved, and the quality of first-time fund managers we are looking at today is, I think, much better than what it was 10 years back.
I would fully concur with that. We fundamentally look at first-time fund managers and evaluate more established managers in the same criteria. There are a few things where we look more deeply at the first-time fund managers, but the main framework for a capital raise is, does the strategy fit the market? Does the team have experience with that strategy, and do they have a history of outperformance? And with a first-time fund manager, that means they obviously don't have a track record together as a team, but they need that attributable track record from their previous firms. And that is more common, and we're able to see that more nowadays in India. One thing that we look at more carefully in India is team stability and commitment to the fund. It is well known among LPs to be very careful about team stability in emerging markets, particularly in India and China, as there's a lot of movement of managers as they hop around different shops. And a lot of Western institutional LPs are looking for a relationship that they can maintain over multiple vintages. So they're looking for a long-term fund to invest into. And similarly, the commitment to a fund is a uniquely Indian problem that I see. There's oftentimes a new fund manager will be a couple of individuals who have built reputations at other firms, and they come up to set their own firm up, and they go out for a few months to do a capital raise, and they realize it's much tougher than they expected originally, and then one of them will go jump off and find a new job and leave the other people stranded a bit. We did work on a number, 3 or 4 funds over the past few years that were in this situation, and now we're at the point with Indian fund managers that we really don't even look at them until they've had a first close. And that's a specific characteristic of the Indian market.
I think just to add to what Bryan said, right, one of the risks with first-time fund managers is, will they be able to close the fund, especially at the fund size they were originally thinking of. So I know all my VC friends here are very fond of a term called traction, in startups. So when LP look at the first-time fund managers, they are looking for traction on fundraising. It's a risk that someone is raising a $300 million first-time fund. You give him $10 million. Ultimately, he ends up raising $100 million. And maybe at $100 million, the economics don't work for the fund manager, or maybe the strategy doesn't work. So I think traction on fundraising it's something very important for LPs.
Yeah, if I were to pick up on that, I think, so Amit, next time if you're looking at that, if we take a fund on board, we ensure that, we have the amount raised. And that's the confidence that we see when we are looking at, taking a fund on board for our investors. But just coming to what Bryan was mentioning, I think, it's very critical that the softer aspects of the team, build the team, stick together, And as I said, it is a long association that our investors are getting in 7 to 10 years. I mean, 7 years is also because we're in India, otherwise globally it's 10 years plus. And we've seen in India as well, by the way, that the fund life goes much beyond the 7 years stipulated. So when you're getting in, it's the team dynamics are the most important. You know, when you are part of a larger organization which has actually gone through multiple rounds, you're sitting on carry, and if somebody leaves, it's easy to buy out, you know, another player in the market, right? Whereas when you're starting afresh, you have a change in boss. When you have a spin out, you have new bosses coming in, so the old bosses to latch upon is no longer there to bring the team together in times of distress, in times of disputes. You have the sponsors, the key, you know, managers stepping in cases where you have, you know, underlying, you know, trouble in the underlying companies, or the promoters need to be. We know how the promoters work. So if we are talking about, you know, PE space, growth capital, it's extremely difficult to get money out of you know, the promoters, right? Dilution is a big you know, question mark, and you know, for God's sake, if they start making money, it's extremely important, you know, impossible, you know, to kind of get that value out of there. So you need those relationships, and that's why I said, you know, when you have spin-outs, or when you have managers who've got hands-on experience of managing and working through those relationships is important, and then coming together, how, you know, strong the team would be. And that's why I think, you know, it's important that the core team members, and I hate to say, but, you know, in most of the startups, you know, our experience has been that in case of core team members, and rather in most cases, it's one team member, which is the lead, or one or two team members. Those team members, their skin in the game. That's extremely critical to see, you know, how much skin do they have in the game, because they will be the sponsors, they would be the anchors who take the fund across, the team across, and if things were to go wrong, you know, their shirts should be at stake.
Absolutely, I think we can all relate. We've got some personal questions on that topic. But just switching maybe gears to the GPs here, Ritesh, if I could start with you. You know, how did you guys, each of the three of you as a first-time fund manager, go about sort of sorting through this vast LP universe, right? I mean, you've got international pools of capital, you've got domestic, and I want to sort of, Narayan, come back to you on that, because I think that's definitely something India needs a lot more of. But how did you sort of start, and sort of, you know, how has that changed as the fundraising has progressed?
I think one of the big lessons that we have learned through the process is that the order in which you approach LPs is super important. We didn't think much of it when we actually started fundraising. And you could, you know, most people in this industry are more left-brain analytical types. We try to sort LPs into you know, various buckets, or at least into a list. And you can sort them by various parameters. You know, we could sort them by size. Let's go to the largest LPs first. They have the most capital. You can sort them by some kind of a perception, on some kind of a perception ladder, the blue chip LPs, and then the next set, and the next set. We found that the most efficient way of sorting in order to maximize your chances of fundraise is sort by your relationship with them. Because in the end, I think as Amit mentioned, traction in fundraising or momentum in fundraising is super important. So rather than some arbitrary measure of attractiveness or some arbitrary measure of size, I would sort, certainly the next time I go fundraising, I would first go to the people who are likeliest to invest in me, where I have an existing relationship. Because success builds upon itself in a fundraising environment for individuals. One more angle on which I would sort LPs is risk appetite. So again, Amit mentioned the concept of closure risk. There are LPs that will take the closure risk, and there are those that will not take the closure risk, and that is their individual risk appetite. One lesson that we have learned is to go with LPs who are comfortable with closure risk, who will put down their 10% regardless of who else has committed at that point. So these are the two factors I would optimize on at the start of the fundraise, the relationship with the LP as well as the risk appetite of the LP.
Heramb? Yeah, I think it's pretty well articulated. Our experience has been similar, and it shouldn't come as a surprise that people who are willing to give you money for a very long period of time in a blind pool are probably going to be the ones who know you the best, who know your capabilities, what you've delivered in the past, and are willing to take that step, especially as a first-time fund. So our experience was very similar. I think the first few folks who came in and supported us were people who had long history with us and who really knew us. But I think beyond that, it really is one of referenceability. And I think, having names that other people recognize, even if the amounts associated with those names aren't significant, but are good triggers to get people to start focusing on you, I think is a strategy that we've tried, mixed success, but I think that's something we thought about and tried to go about doing. I think this point on traction is a very important one. I think it keeps coming back over and over again. And I think the big elephant in the room, frankly, is the India question, right? I think 9 times out of 10, when we have a conversation with a LP, their view on whether they like the proposition or not depends on whether they were investors in the past cycle. For most of them who were investors in the past cycle, high likelihood they got burned, and they are really trying to figure out what has changed, but with a very healthy dose of skepticism around anything to do with India. And so a lot of our pitch really has been around why we think the structure of the industry has changed, and that structural change has created opportunities. But I think if you've lost money, your attention span goes down quite quickly. So another quest for us has been to find LPs who perhaps haven't invested in India in the past, are now hearing about all the good stories coming out of India, and would be willing to give it a shot again.
Abhishek, your thoughts?
I think I can't disagree with any of the points which I've made. I think in a nutshell, what Ritesh said, people who know you the most, the closest, are always willing to take the most amount of bet on you. We raise largely domestic capital. Indian families are more risk-taking. If they like a guy, they like to back them because they are largely so-called quote-unquote promoters of companies. So they like that association. Reasons for investing are not often just returns. They tend to be a wider relationship. They like the association and so on and so forth. But they come in early and they are willing to take the risk of whether a close happens or doesn't happen. They just commit an absolute amount. And for us, we figured out fairly early that what we want to do is we want to be active and be in the market. So we get the capital, we start doing deals. And at different points in time, different LPs will find that we have qualified the criteria. So we said rather than force-fitting ourselves and trying to get to DFIs or trying to get to somebody else, we'll take whichever pool of capital thinks that we are deserving of them at this point in time, start doing some deals with that. And hopefully in the goodness of time, the number of people who deem us to be fit would be a wider set of people and will become more institutional in nature. And that we think by and large has worked out well for us.
Oh, that's very interesting, and that's probably a good segue, Narayan, to the question that I had is we have some team members who have done venture investing in China and the US, and the experience in China is that sort of the whole growth in the venture business was on the back of domestic capital coming in. So from your standpoint, what do you think? Obviously, I think Heramb's point about the LP experience applies to Indian HNIs as well, and the family offices. There just isn't that much institutional capital for most of our strategies, right? So how do you see this playing out, or what can all of us be doing to sort of try over time to increase the domestic capital that's available for funds and particularly first-time fund managers?
Yeah, so, and I do agree with that, Indian market is largely, H&I and family office market. And increasingly after the last cycle, I think, as Heramb mentioned, the global money is looking for Indian anchoring as well to come in and follow on ground. So, but just coming back on the domestic side, and I do agree with, with Ritesh as well, that effectively, Indian investors do have the risk appetite to make an investment. But it's the other way around from our perspective, what we try and look for, as I mentioned, there has to be a niche for first-time managers. There has to be a niche that you're bringing on board. To say that, not that we see that tremendous amount of money is flowing into the existing on follow-on funds from these set of investors, they're more likely to make investments into niche funds and first-time fund managers, believe me, rather than follow-on funds. The follow-on funds are getting perhaps money from institutional investors and the global LPs, they're repeat LPs.
So we're all going to come and spend some time with you after
Yeah.
this.
So there is while there is an appetite, as I said, where people lack conviction is, as all of you all mentioned, is that relatedness, direct relatedness is not there. It will not be there beyond a few families, perhaps. So if you need to reach out beyond that, it is, at the end of the day, the reliance on advisors like us. And from our standpoint, what we look at is whether this marriage is going to last and how long will it last. And that is the core point. And it's not just that. I think one of the points that I missed last time was talking about is the J curve that goes, because most of the first-time managers, you're talking about $100 million, $200 million at max. And with that kind of money, would you be able to sustain a team which pulls together? And believe me, your competitors, the follow-on managers, and the global investors, are looking for your teammates, right? So in that, whether that team, whether the management would stick together is the core question that comes to mind. How do you plug that in? Again, it's a matter of watching it over a period of time. Not saying going into the follow-on funds, but as Bryan mentioned, to at least see for the first closure. In some of the cases, if we feel that there is a niche and that cannot be fulfilled by the larger fund houses, because these opportunities are not as big for them to be making a difference into clients' portfolio, then we do go out and take that chance. But risk-taking has to still be on the back of a solid diligence, right? So, but niche is the answer. If there is a niche, then, so somebody talked about IT, somebody talks about non-IT space, someone talks about, a niche in non-dilutive funding and so on. So there are various spaces, but there has to be something different.
Bryan, if I could come to you next. I think you have a unique vantage point, as you said, with the placement agent role, sort of sitting in between the GPs and LPs. One of the things, at least from the GP side, with active listening and all the EQ skills that we have, what are LPs really saying to us at the end of the meeting? Because there's definitely rare that you get a yes or a no, but there's always some, sort of shade of maybe. What should we be sort of interpreting? What are the codes we should be sort of looking for and taking away from that?
It's a great question. It depends culturally where you are. So a Japanese LP will always say that's interesting and thank you for coming, and you'll have no idea. American LPs are far more straightforward. But it also, as an intermediary, it's nice for us to be able to follow up with our LPs after the meeting and get a little bit more frank feedback at times. But it's a long process, and there is you're building a relationship. And fundamentally, this is a relationship business. So at every chance you can take as a fund manager, you are trying to build empathy and establish a connection with the LP. Try to see yourself from inside their shoes and try to establish some sort of personal connection. And that's really, at the end of the day, what will get you across the line.
And Amit, I'll bring you into this to help decipher the code that you guys use, but also want to take you back to the word you use, right? Traction. So clearly there is sort of the fundraising traction. But what would be sort of the other proxies that you would look for a first-time team coming out? What, how could traction manifest itself besides saying, okay, I've got my first close, I'm X% of the way to my target? What are the things that you guys would look for?
One of the things first-time fund managers can do to really get the attention of LPs is not going out with a blind pool. And there are a few ways you can handle it. Let's say you are working at a global PE fund, right, and you are spinning out. So one of the ways you could do it is, rather than just spin out and start from scratch, take some of the assets with you. Just go to your, fund and say that, hey, we'll manage your India assets for you and we'll buy them out from you. And then go to LP saying that, hey, this is a portfolio that, that these are investments that we made. We need $200 million to buy these out. Will you give us the funds to buy this? And that makes so that makes for a very interesting story. And we have seen some funds which have done exactly this, like NewQuest, when they bought out the Merrill Lynch portfolio. So this is one way of doing that. Another way of doing it is, get a first close done, and then, make a couple of investments. So then when you're going to other LPs, you have something to show on the table. That these are 2 investments I did, these are the way we sourced them, this is how they are doing. So I think that's a good way of getting attention from LPs.
Bryan or Narayan, any thoughts to add?
Sorry, if I may just add on what Amit said, I think there are various other ways as well. So I do appreciate this approach of rather than actually going in for blind pool, because blind pool is what is making things very complicated, right? Because you're asking them to just sign up and wait it out for 7 to 10 years, right? So a good way to start could be that come as a co-investment fund. I mean, there are concepts and there are ways and structures in which one can execute that. The risk to that is when you're going to actually source transactions, you don't have committed money, right? But there are, again, ways and means to achieve that as well. And we've done that with several managers in the past. And there are managers that we're working with for the last about maybe 4 to 5 years. And we've had series of transactions. We've actually reached out saying that, this is by the time, maybe time now that you might actually want to raise a pooled investment. And the response from the global team came in saying that we are good the way we are, which is basically every time we have an investment, you guys have committed capital, right? And there are structures which, some of the managers in the past, I mean, there are a couple of managers who've actually worked with SEBI to have these open-ended so-called structures in which you can have an open pool of commitments coming in, and you can take the commitment based on, the transactions that you get. So more like a see-through fund. So these are some of the solutions that can actually work very well, where you're not binding the investors into a pool. And at the same time, it may perhaps allow these managers to increase the total commitment that you can raise by multifold, if you ask me.
So, Amit, I just want to go back to what Heramb said a few minutes ago about sort of the baggage of LPs have with India and sort of, getting through that before you really drill down into the strategy. So, I just guess from your vantage point, and I'd love to get Bryan's take on this also, you commented about it a little bit at the open, is that changing relative, in today's context where India sits, relative to other emerging markets or the developed world, or is that baggage still very much there as you think about it? And obviously this is a bigger question than just first-time funds, but just from the India perspective, how big of an elephant is it?
So I think there still is that baggage about, LPs have in their mind that, they just read the headlines and they see that, money not being made in India as much as in China or somewhere else. But, we also need to realize that, this private equity in India is a young market. And there was a lot of capital which came into India in 2007 when there was a lot of excitement. So such a thing was bound to happen, and partly, LPs are responsible for that. They gave all the money out to, inexperienced fund managers during that time. So I think this is a market which had involved, and we at least are very excited about this market.
I still think there's a very negative cloud over India. There's a lack of exits, as everybody says, the currency, high valuations still. All of those, I think, are being moderated over the past year. So I think it's an improving climate, but it's still very negative. And what's interesting in my experience is that the LPs that have been investing the longest with us and earlier on in the early 2000s are some of the most negative towards India. And that's because they aren't seeing the liquidity in their investments, and they're seeing outperformance in China and other geographies over their India portfolio. As a side, I think the opportunity for capital is not in a lot of these more established LPs that have more mature portfolios. It's actually, in North America particularly, it's among more the mid-tier endowments that are just building out their emerging markets and their India programs. And similarly, the mid-sized foundations that you probably haven't heard of, or city pension funds versus the larger state ones.
Thank you. This, I guess, is the last panel, and thank you all for sharing your insights, and thank you to VCCircle.